Thanks for joining me this Friday, the 26th of September. I'm Grady, Senior Market Analyst with Bell Direct, and this is our weekly market update. September's market volatility extended into this trading week, with AI overvaluation, inflation and visa fears on a global scale sparking escalated market uncertainty, leading to a sell-off among many major global indices. The uncertainty also propelled gold to new record heights this week, which boosted our local gold miners even further into the green over the course of this trading week. Locally, we had the latest monthly inflation print released this week, indicating the RBA's job on taming inflation is not quite done. Despite the RBA preferring the quarterly data of this kind though, this week showed inflation on the monthly scale. CPI indicator rose 3% annually to August 2025, with the largest contributors being annual housing inflation up 4.5%, food and non-alcoholic beverages inflation up 3%, and alcohol and tobacco inflation up 6%. The end of the government's electricity subsidies also saw annual housing inflation was 4.5% up to August, up from 3.6% to July, reflecting increasing electricity costs, which rose 24.6% in the year to August. As a result of the latest CPI reading, investors, in true fashion of late, reacted very negatively by fleeing rate-sensitive sectors, including REIT and discretionary stocks on Wednesday. Overall, the RBA's inflation journey to tame the economy is looking pretty good. The economy is looking stable and inflation remains under control, according to the latest data across the key drivers of inflation. So let's dive into each of them and see how they're faring. Wages price inflation was a key sticking point that fueled the RBA's prolonged rate hold over cut decisions until recently, with the latest wages data showing that for June quarter, seasonally adjusted wages rose by 0.8%, driven mainly by private sector growth, which also rose 0.8%, while the public sector wages increased 1%. Annual wage growth remains steady at 3.4%, the same as the March quarter and lower than the 4.1% seen a year earlier. With the trend now flatlined as of the latest reading, the RBA will be cautious to see if an uptick or maintenance of WPI is achieved in the next quarterly data for September due out soon. The unemployment rate down under remains pretty stable and low, which is a key factor the RBA considers when devising the rate journey. In seasonally adjusted terms for August, the unemployment rate remained at 4.2%, significantly below the 6 to 7.4% band or range that we saw over the years from 2015 to 2021. And that remains stable within the range, indicating that many Australians remain employed. In terms of economic health and expansion, Australia's latest GDP reading outlined the steady uptick in economic growth continued into the June quarter as GDP rose 0.6% quarter on quarter and 1.3% over 2024 to 2025. Now, despite the annual figure being the weakest year-on-year growth since the 1990s, obviously excluding COVID impact of 2019 to 2020, a rebound is in sight as GDP per capita rose 0.2% this quarter, following a decline in the March quarter of 2025. Retail spend has remained resilient and another sticky point of the RBA's rate journey, despite elevated cost of living pressures over FY25. But with the trend only steadily inclining as inflation eases and GDP remains robust, this signals that the RBA's rate decisions to date are working for a soft landing without inflation cooling into a recession. And finally, producer price index, another key driver of inflation, came in at an annual rise of 3.4% for the 12 months to June, down from 3.7% reported in the year to March, and well below the peak of 6.4% in September 2022. The gradual decline signals cost pressures are easing for producers and remain under control for the RBA's rate journey. Understanding the rate outlook and journey of inflation taming is important as an investor, as you can navigate the market to find the best opportunities and sectors with the greatest tailwinds to match the rate outlook. As there is at least one anticipated further cut out of the RBA to come this year, if not more, sectors that are rate sensitive like REIT, retail and tech stocks will feel tailwinds, while the banks and utility stocks become less favourable in a low interest rate environment. Locally, from Monday to Thursday, the ASX 200 posted a 0.32% rise as a surge in materials stocks boosted the key index into the green over the trading week. Commodity price spikes for copper and gold were the primary drivers of the materials surge this week. The winners were led by Lynas Rare Earths, rallying 16.3%, while Megaport and Drone Shield rose 14.3% and 13.6% respectively. On the losing end, Viva Energy and Domino's Pizza declined 8.4% and 7.5% respectively this week. On the broader market index, the All Ords posted a 0.36% rise, as Chalice Mining soared 32.2% and Barton Gold jumped 28.72%, while Regis Healthcare and Myer plunged 29.2% and 28.1% respectively at the other end of the market. The most traded stocks by Bell Direct clients this trading week were Regal Partners and Phineas Corporation Holdings plc. Clients also bought into BHP, Woodside, CSL and Austin Engineering, while taking profits from Mineral Resources, PLS, Northern Star Resources and ANZ. And the most traded ETFs this week were led by Vanguard Australian Shares Index ETF, Vanguard MSCI Index International Shares ETF, and iShares Global 100 AUD ETF. Looking to next week, ahead on the economic calendar front, we may see investors react to the RBA's latest rate decision out on Tuesday, where it is widely expected Australia's central bank will maintain the current cash rate at 3.6% for the next period, while Australia's latest trade balance data is out on Thursday. Overseas, we'll see key US jobs data for August and September out later in the week, and earlier in the week, China's latest manufacturing PMI will provide an update on the status of the world's second largest economy from a manufacturing perspective. And that's all for this Friday and week. I hope you have a wonderful weekend and happy investing.